Okay, welcome everyone. We'll start our lesson 2. Today lesson will go through LO2, Learning Outcome 2. As you, couple of you know me, my name is Anjum Sattar. If you have any question, please drop me email anjum@ukversity.co.uk. Please make sure carry on attending regular session. And today lesson will go through our LO2. Okay, so as we discussed the aim of this unit during our last lesson, have effective finance and accounting function will not only be help to secure the financial strength but the business, but will also be sports managers to develop and implement the business strategy. Okay, so today lesson we have 4 assessment criteria, differentiate between different financial statement for sole trader, partnership, limited companies, and we can look around adjustments, and that's the key which we'll look around today. Financial statement, so we can look around different financial statements. Okay, different financial, so that will be our key, which we'll go through in a minute. Okay, so guys, so these 4 type of financial statement which we'll discuss, and sole trader, partnership, limited company. Okay, so always good to be reflect what your current knowledge about financial statement, FS, financial statements, scale 1 to 10, what you know. Okay, so we prepare 4 types of financial statement. That's we'll start. So financial statements, yes, for sole trader. What is meant by sole trader? 1%. On 1% business. Yes, sole trader prepare financial statement for sole purposes, and they have to prepare 2 most important statement of financial position and statement of comprehensive income. Normally, as a sole trader, because your business is not, you don't need to be thoroughly apply IES, International Accounting Standard 1. So we prepare profit or loss account, you can say, yes. And financial position, we can say balance sheet. Yes, so that's the key which we need to look around. Okay, but in case of company and sole trader as well, statement of cash flow, we can prepare statement of cash flow. We can look around how much money in and out from the business. But statement of change in equity, that's not really change in equity or equity statement. It's not really compulsory in sole trader, and because there are no other investors, only 1% business, that's why. That's so these are the statement we prepare. So balance sheet shows assets, liabilities, and capital. Yes, that's we need to be. And profit and loss shows income and expenses. Yes, that's we need to. And cash flow shows inflow and outflow under 3 major activity: operating, financing, and investing. And this statement of change equity shows that. And if you have partnership accounts and partnership, then we normally prepare the appropriation accounts as well. We can see the partners, sharing ratios and things, that's also crucial to show. Okay, under IAS 1, International Accounting Standard 1, statement of financial position, statement of profit and loss, statement of chain equity, statement of cash flows, and financial statement rate, fair financial position, financial performance. And we look, these need to be faithful representation, conceptual framework which we follow, and the international financial reporting standard. Nowadays company have operation throughout the world, so that's why we follow. Okay, when you looking these statements, you have to be make sure You have the statement reflect the financial statement once prepared is a going concern basis unless the entity is not going concern. Accrual basis, all each year's income and expense should be offset and matched with the year. Materiality, all the materiality information should be shown in the financial information. Not significant transaction will be offset on the balance sheet or the income statements. State assets and liabilities and income and expenses should not be offset unless they are required permitted by standard. Consistently presentation, yes, you follow the consistent rule costing methods, not every year you carry on changing like activity based costing, absorption costing, marginal costing, because otherwise the figures can be under or overstated. So this is the layout under IES 1. We can look around the balance sheet, statement of financial position. We show all the non-current asset first, then we'll show the current asset. Then we can show the land, building, plant, motor vehicles, and these, and their depreciation is depreciation under IAS 16, International Accounting Standard 16, will make adjustments. Okay, then we have a equity. Equity will show the share capital, share premium, revaluation, and total equity. Always will say double entry, right hand side should be equal to the left hand side. So my debit and credit should be equal. So my assets goes on the debit side, first half that statement, and second half is your equity and liability. If you do total asset minus liability equal to net asset, and net asset figures always equal to equity figures, always keep in mind. Okay, so current asset, we know the asset which we can use for a short period of time, normally 12 months in their figures carry on chaining, operating cycle, and current liability, anything which we have a legal obligation to settle within 12 months. So that is our current liabilities. Okay, as we discussed earlier, sole trader, partnership, limited company, we prepare their accounts. Sole trader mean the 1%, partnership 2 to 20, and limited company registered in the company house. And then other business can be charity business, non-profit organization registered under the charity commission and will submit these financial statements. Limited liability, yes, as we know, the liability is limited. Nobody can claim for their personal asset in term of the company, and they have to follow the lot of legislation, and that's which we need to be really follow these very closely. And the funding, if you want to be fund your business, we can use the retained profit, previous year profit, share capital, short-term liabilities and loans we can, and we can fund the business. Anyone, any question? Please, if you have, you can ask. If the company can be two types, which is called private limited company and public limited company. So private limited company, if you want to set up such as a Unilever, we need £50,000 worth of, they can issue shares to the public. Okay, we'll show their debt and equities. We can borrow money, but debt is cheaper than equity normally. And that's, which we need to keep in mind. Partnership, as we discussed to have more skills compared to the sole traders, and their statement need to be appropriation account that need to be appropriately educate. And we have a Partnership Act 1819 in UK, which we follow. If you don't have a written deeds between partners, we'll share equally our profit and loss. That's we need to be follow these legislations. Okay. Partners can be 2 to 20. In other part of the world, if you're doing insurance business, partners can be 2 to 50. Yeah? That's we need to be make sure we'll carry on. Okay, Company Act we follow in the UK 2006. Company registered in the company house, and all information financial statement should be true and fair. Yes, that's the true and fair is the key word there in the financial statement, and we prepare. Okay, if your partnership can be registered in the company house as a limited liability partnership and it's become a company, then yes, then you have to follow the law. Then there is a no limit of 2 to 20 people. Okay, this is the statement of profit and loss. Always revenue come first. Revenue also known as, please remember always, revenue, turnover, and sales are same thing. No difference. So that's we need to be. Revenue, profit, turnover are the same thing. There is a no difference. That's we need to be. Revenue, cost of sales, gross profit, distribution, administrative, profit, operation, finance. Yes, profit and loss. All we need to be follow. Okay, then if you have a gain, other income, always we show in the income statement as well. Yes, and we prepare under IS1 if the company especially. Okay, total comprehensive income, profit income has minus expense, then you have other incomes gain, and we'll say total performance. So closing equity, opening equity, different equity, which is mean, the last year capital, because the income for the year is a part of capital, always keep in mind. Okay, this will be the look like statement of chain equity. We can look around share capital, other reserve, revaluation reserve, return earning, total equity at the start of the year, at the end of the year, during year, what changes happen, how much dividend paid, how much shares we issue, we always carry on showing because that's a crucial to show in the financial statements. Okay, so statement of financial position, assets and liabilities, statement of profit and loss, income and expenses, and statement position at the end. We can look around closing equity. So at the opening, so the profit for the year or loss will be adjusted in the so property, plant, equipment. Yes, we look around tangible assets and intangible asset. Tangible is mean anything which you can. Okay, property, plant, equipment is one of the key item. Really, we need to be. Okay, so we need to be make sure we'll carry on recording recognition. Yes, directly attributes subsequent distribution of the expense, which we need to be make sure we'll carry on doing. Cost model, yes, we can do the revaluation gain. If we have a revaluation loss, asset being revalued based on we have to be follow IES 16 to do revaluation. Yes, asset need to be revalue, cost or economics value, whichever is lower, not higher. Always remember, please, cost fair value is the market value, and accumulated depreciation and then revaluation reserve. We can look around the fair value carrying amount based on the original cost and revaluation model we use. So basic rule that recognize the depreciation for each period in the profit and loss, allocate depreciation systematically basis the useful life of the asset and depreciation amount, cost, fair value, residual value. Yes, we'll carry on. And residual value is the estimate at the end of which we can, and IS 16 we follow in the company. Yes, review the depreciation charges, depreciation, residual, useful life. Yes, you can use the depreciation methods with the straight line or diminishing balance methods. Yes, so we can show the whole schedule, how much land and building, plant, machinery were, how much start, how much revaluation. So we can produce the separate is all the breakdown as what is the net carrying value at the start, at the end of the year. That's which we need to show to the financial. Okay, guys, so anyone, any question until I quickly 1 minute, I'll show you each, sole traded, partnership, and limited company separate statements. So that will help us, to differentiate. Slightly the layout can be different. So that will help us, to furtherly clarify and do things accordingly. That's, which we need to look around because that's the most important. Okay, just spend few minutes. Okay, guys, let's quickly show you what's is look like the difference layout can be in term of partnership. If you have a sole trader and partnership, so partnership and sole traders profit and loss normally look like quite similar. Like you will see the accounting partnership and profit and loss layout of the financial statement. So, but if it's a partnership, we prepare the appropriation accounts. Step one, so we can prepare whatever the profit you have from the partnership. You're looking the partners if they are getting salaries, expense for business, interest on capital is expense. If you have a drawing, you draw for personal use, something, and the business charge on interest on it, that will be income for business. So we have an example here. We have a profit, and then sharing ratios will contribute between partner A, partner B, partner C, according to 40/20 and 40%. And please, that's we can look around example. So sole traded and partnership accounts, you will see the capital. If we have the partner have and the capital account, we can in the financial position will be look like slightly different then, and their capital account we can prepare separate partner A, partner B, and their current account, how much money being profit and capital they have it being allocated to, and if they have a drawing or if they have an interest on drawing, so that will be debited and credited, and will make adjustment accordingly. Goodwill, as you know, the value. So if the old new partner and old partners, the goodwill need to be paid and goodwill adjustment entry need to be made in term of account. So you will do the debit and credit, debit the goodwill and credit, because it's not really physical transfer, it's just making adjustment, because the new partner should pay more capital than the old partner because they develop, the goodwill and the business a good number of years. That's we need to look around. Admission of new partners, we need to look around, they bring the capital, and we need to make new sharing ratios between partners under the partnership and balance, which will carry on, and we'll carry on preparing the nominal ledgers. That's, which we need to, if we have, like you will see the, if we have inventories, inventories need to be readjusted and revaluation, like, revaluation under IS2. We follow GAP's general acceptable accounting principle in UK, but nowadays, if we have a business internationally, we can follow IES international accounting standards. And we said, UK accounting standards and international accounting standard can be, and we can look around principle based approach. We prepare the financial statement according to various accounting standard, which we follow now, international accounting standards. Okay, as we discuss framework, conceptual framework, set out the principle, and international standard board issue the, and they give the standards, and those we follow. Okay, so this is the format of, the layout, which is normally in terms of the companies we follow. Yes, under IES1, so we can reducing heading, so we put in distribution, administrative, all expense under these finance cost, so we can look around profit before and after. As we mentioned earlier, balance sheet will be look like this format. Yes, intangible, tangible, current asset, and live equities, non-current liabilities, and current liabilities look like this layout. And a cash flow statement can be divided into direct, indirect method, and the cash flow statement we can look like, this way we can follow indirect and direct method. So operating activities, financing activities, and investing activities, these are, and direct method we can look around increase or decrease of cash under receivables. Okay, so this will be the layout which will look, the different companies financial statement, net operating activity, net financing activity, net. So we can, operating is a normal business, investing if you're buying and selling non-current asset, and financing if you're borrowing money through loan or issuing shares. Are you paying dividend? Are you settling? That will be throughout, the year will show in the, and I copied the link for you. Please, if you look around next PLC and the Marks and Spencer, by using these links, will help you to explore and look their financial statements. Okay, and you have all the reference, those we use. And if you have any question, please, you can drop me email or drop us email. Thanks for attending today. So today we'll discuss about the financial statements. Four types of financial statements: statement of comprehensive income, statement of financial position, statement of cash flow and statement of chain equity. These are and sole trader partnership and limited company. And we discussed depreciation need to be make adjustment under IES 16, fair value or revaluation at cost, and always whichever is the lower we have to do. Thanks for attending and hope so speak you all during our next lesson. Thank you. Bye bye.